Hello traders, and welcome back to Explain the Charts. Today is October 14th, 2025, and we are doing a deep dive into the S&P 500 ETF, ticker symbol SPY. The market has been on an absolute roller coaster, and today we're going to break down the news driving this volatility and what the charts are telling us about the next potential move. As we look at this daily chart, we can see the market has been in a strong uptrend for most of the year, recently setting new all-time highs. However, the last few trading sessions have been defined by extreme geopolitical news. The main catalyst has been the U.S. China trade situation, with President Trump's comments acting as a primary market mover. We saw reports of renewed threats to impose an additional 100% tariff on Chinese goods, which sent the market into a tailspin last Friday. Conversely, a softening of that tone over the weekend led to a massive rebound yesterday, on Monday, October 13th. Beyond the trade drama, we have the Federal Reserve minutes pointing to more rate cuts ahead, which has been a persistent tailwind for this bull market. This expectation of cheaper money has helped investors look past some of the risks and continue buying dips. We also have the start of earnings season, with major banks reporting this week and high expectations for strong results, which could add more fuel to the fire. However, there are also headwinds, like the ongoing government shutdown, which is creating economic uncertainty, and growing whispers on Wall Street about a potential AI bubble. Now, let's correlate this news to the price action right here on the daily chart. Let's zoom in on the last couple of weeks to see this play out more clearly. In early October, the market was grinding up to new all-time highs, closing above 673, fueled by that optimism around Fed rate cuts. Then, on Friday, October 10th, the tariff news hit, and we saw a brutal reversal. Look at this massive red candle. The market opened near the highs and plunged nearly 3%, closing at 653.02. This single candle erased 2 weeks of gains and established a critical new support level at that low of 652.84. The high of that day, around 673.95, now stands as formidable resistance. Following that, yesterday's session on October 13th tells the other side of the story. The market gapped up significantly on the open, a direct reaction to the softened stance on China tariffs. This created a large price gap between Friday's close of 653 and Monday's open of 660.65. Traders will be watching this gap very closely, as gaps often have a tendency to get filled in the future. Yesterday's price action pushed higher, but failed to reclaim all of Friday's losses, closing at 663.04. This leaves us in a precarious position, sandwiched between the panic of Friday and the relief of Monday. The key battleground is now clearly defined. The bulls need to push past yesterday's high of 665 to show conviction, while the bears will be looking for a move back down to fill that gap. To get a better sense of the short-term battle, let's drill down into the 15-minute chart. Here on the 15-minute chart, we can see the anatomy of these wild swings. This is the chart for Friday, October 10th, where we see a relentless, session-long sell-off triggered by the tariff news. There was almost no buying pressure all day as the market cascaded from the 673 level all the way down to that close near 653. Now, switching to yesterday's chart, October 13th, you can see the enormous gap up on the first candle of the day. Price opened at 661.5, immediately erasing a large portion of the previous day's losses. The market rallied for the first couple of hours, peaking just above 665. After that initial morning rush, the price action spent the rest of the day consolidating in a range between roughly 662 and 665. This tells us that while buyers were eager to step in on the good news, there wasn't enough conviction to push all the way back to the highs just yet. The market is now in a state of short-term equilibrium, waiting for its next catalyst. The intraday high around 665 is now a clear short-term resistance level to watch. The low of yesterday's session around 660 acts as the first line of defense for the bulls. Now, let's go back to the daily chart to discuss the scenarios moving forward. So, what's the game plan from here? Let's outline the bullish and bearish cases. The bullish case rests on the idea that the market's primary trend is still up, supported by the prospect of more Fed rate cuts and a strong earnings season. In this view, the tariff threats are just noise, and investors will continue to buy these dips. For the bulls to prove their case, they must first decisively break and hold above the 665 resistance level. A successful move past 665 would open the door for a retest of the all-time high resistance zone between 673 and 675. On the other hand, the bearish case is that the geopolitical risk is too high to ignore. The market has shown it will sell off hard and fast on negative trade headlines. A weak start to earnings or any indication that the Fed is reconsidering rate cuts could also spook investors. The first major warning sign for bears would be a move down to fill the gap towards 653. If the price breaks below that critical support level at Friday's low of 652.84, it would signal a significant reversal and could lead to a much deeper correction, with the next major support area not appearing until the 640s. Let's quickly recap the key levels and give some final thoughts. Your upside resistance levels are 665 and the major zone at 673 to 675. Your downside support levels are the top of the gap around 660 and the critical line in the sand at 653. My primary expectation, with about a 60% probability, is that the market will attempt to grind higher this week. The path of least resistance has been up, and the prospect of good earnings and Fed support is a powerful combination. This scenario is reinforced if we see SPY close above 665. However, there is a very real 40% probability of a bearish move. The market is highly sensitive to news, and a single tweet could send us back down to test that 653 support level. A break below 653 would invalidate the bullish thesis in the short term. Things to watch for are the bank earnings reports this week and any headlines out of Washington or Beijing regarding trade. The APEC meeting on October 31st is also a huge upcoming event that traders are already positioning for. Finally, please remember that this analysis is for educational purposes only and is not financial advice. You should always conduct your own research and make investment decisions based on your own risk tolerance. Thanks for watching Explain the Charts, and good luck with your trades.